One of the most important things to understand about your retirement spending is that your spending patterns will change over the course of time. So in today's video, we're going to talk about how will those patterns change and what does it mean in terms of how you need to invest your portfolio differently to account for this. Joining me today is Erin. Erin, thanks for being here.
Thanks for having me.
When people are working, it's easy enough to fund their lifestyle. You have a paycheck, you have cash flow, any monthly expenses, those are coming from your paycheck, any kind of one big one-off expenses you're saving from, and then you retire. And that paycheck obviously goes away. And not only are you thinking about how do I fund today and tomorrow, but you're also thinking of how do I fund 10 years from now, 20 years from now, 30 years from now, using this one portfolio asset, maybe in conjunction with other resources to do so. And so we're going to talk a lot about that today. And as you're thinking about that, even I think the biggest thing is, what does spending look like for people in retirement? Where should people even start when it comes to understanding what their portfolio needs to look like to match their spending in retirement?
I think, even before you step away into retirement, at least like the 5 years leading up to it, you should really be tracking what your expenses are. I kind of lean towards the side of having a paid off home if you can get that big expense out of the way, but you should know what your day-to-day expenses look like, what your major expenses look like. If you have any big expenses coming up, like replacing a roof or having to replace a vehicle, but like 5 years out before retirement, I think is a really great time to do like a detailed tracking so you don't get to retirement and then you're like, oh, I didn't even know that I had this expense coming in June and it's an extra $5,000. So where's that money going to come from? So detailed tracking, I would say. What would you say?
Yeah, I think that's a great point, because I think that it's easy enough when you're working, just I've got a salary and there's enough margin in there to be okay.
Yeah.
And that goes away when you're
Mhm.
retired. And it's less about starting with income in retirement. It's more about starting with expenses.
Yeah.
And then where do you pull income from? Whether it's
Yep.
Social Security or pension or your portfolio or cash savings, or you fill in the blank. And that's why it's so much more important to understand what exactly are those expenses. And I think a big thing that people, I don't want to say get wrong in a bad way, like they just don't know, is okay, let's say that number is $100,000, just to use a
Yeah.
nice, simple number. I know for a lot of people it's not that, but that's a round number. We're going to go with it. They might think, okay, if 100,000 is the number and there's inflation, does that mean next year I need exactly 103,000 and the following year I need 106,000 and change, and the following year? Is that the right way to think about it once you do have your number?
I don't agree that your expenses go lockstep with inflation because things for the vast majority of retirees, right? Most retirees are homeowners. There are a lot of renters and they can expect that their housing expenses will increase. But for retirees who either have a mortgage or if their home is paid off, well, your housing costs aren't going to change that much. Yeah, your taxes will, your insurance will, but they're probably not going to increase at the same rate of inflation. And you can do things to sort of adjust your lifestyle. You can adjust how often you eat out. You can adjust like what kind of groceries you buy. So if you plan that you can kind of be a little bit flexible with your spending, you could change how you take a vacation. Do you fly business class or do you fly economy? I think there's modifications you can make, but I don't think it's a perfect coordination with inflation. I think your expenses might go up a little bit, but I think they go up less than inflation is what I would say. Yeah. Yeah. Mhm. Yeah. Yeah. Mhm. Mhm. Yeah. This research came from Chase. So they looked at 5 million households and they noticed during the first phase of retirement, we can call that like the go go years, that spending actually increased on a real rate about 2%. And then once you get into those mid retirement years, spending did increase still, but tended to slow down a little bit. Maybe it increases at, say, 0.5% a year. Then you get into the very later stages of retirement. Maybe this is age 87, 90, 95. And spending really starts to take a dive here because most people are not, traveling to Europe or they're not going to Disney World when they're, say, 92. They could be, but most people aren't doing that. They're staying closer to home, maybe visiting family, some social activities. So you'll see that spending in healthcare in this time tends to go up, but real spending overall, because it's declining in pretty much every other category, really tends to decline. Mhm. Yeah. Mhm. Yeah. Mhm. Mhm. Yeah. Mhm. Yeah. Yeah. Mhm. Yeah. Mhm. Mhm. Yeah. Yeah. Mhm. Mhm. One of the things, just speaking about the stats of, say, like a 70% probability of success or like the 80% probability of success, one thing I like to tell people is that you have flexibility with your spending. For the vast majority of people, there are ways you can cut back if, say, you want to do a lesser withdrawal. You don't have to say your budget is 100,000. I bet there's modifications you could do that maybe next year you could do 95,000 if you were feeling a little uneasy. There's small modifications you can do that add up. I still believe that you should plan for a long retirement and you should be invested. And I think focusing, like you said, too much on those probability numbers, people get a little hung up. Like they want to have like a 95% probability of success or a 100% probability of success. But if you look at other stats, maybe we consider the rule of 4%, right? Like people withdrawing just 4% plus inflation on an annual basis. The people who follow that path, 95% of them end up with more money in 30 years' time than they actually retired with. So overwhelmingly, the vast majority of people are successful when they follow these guidelines. So I'm like you, I don't get hung up on the 70% probability of success, because when we look at those are usually factoring in something like the Great Depression or these absolute worst case scenarios that we don't really see that often. Not to say we couldn't see them again, but I think if you have different buckets to draw on, if you can remain flexible in your spending approach, that you don't have to get so focused on the number. Yeah. Mhm. Um, I'm still a pretty big advocate for making sure you have exposures to equities, because inflation is going to happen. The purchasing power of your dollar will reduce over the course of years and decades that you have in retirement. So I think you have to make sure that you have a portfolio that's still capable of growth. Now, everyone's exposure to stock kind of depends. Like, how risk averse are you? Are you capable of absorbing a lot of risk? Can you have these major fluctuations in your portfolio? Do you want lesser fluctuations? But I really don't think for the vast majority of people that we should dip below at least 50% in equities, because you have to have some growth over those years to maintain your purchasing power. And I really think people underestimate the role that Social Security will play in their retirement. A lot of us who are very just strong advocates for investing, we focus on what our portfolio is and trying to have our portfolio just replace 100% of our income. But for a lot of people, Social Security could be two, three, $4,000 a month if you are a high income earner. That's going to go a long way towards supplementing your retirement income, especially if you're in a dual income household. Mm-hmm. Yeah. Mm-hmm. 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 Yeah. 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 Mm-hmm. Yeah. Yep. Mm-hmm. Mm-hmm. Yeah. Mm-hmm. 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 Hmm. Yeah. Hmm. I would say that's an approach that I very much agree with. I think everyone should have this huge cash buffer that they go into retirement with. And I kind of like to pay attention to what the market is doing. If we have a very robust market, like what we had last year, it's up 20+%, I wouldn't actually touch my pool of cash. I'd be the person who draws from my portfolio because it's at peak levels. So why not take a withdrawal when it's high? It can absorb anything we take out of it at that point. My cash reserves I want there for when the market is on a downturn. But I love the idea of like a 5 year cash bucket, or even if people can't get to a 5 year cash bucket, a 2 or 3 year cash bucket. But you just don't want to touch your investments, especially in those first couple of years, because you can jeopardize the long term viability of your portfolio if you're drawing in those first years when it's down. So if it's down, I would turn to the cash bucket. If it's up, I would go from my investments. And even, as you said in the beginning, when maybe you're spending more, I would be fine with people taking more than 4%. If you want to do a 7% withdrawal and 8%, and because those are your high expense years, if you have a robust portfolio, it can absolutely sustain that. And then as you get down the road and you have a lower draw on your investments, totally fine. I don't think there's like this static number, but I don't like to put out there like, oh, you can withdraw 12% every single year. Yeah, that's not going to last. But I do think that's fine in your beginning years. If you have a robust portfolio, absolutely, you can go way above that 4% number. Mhm. Yeah. Mhm. 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 Yeah. I mean, if you consider people, say you have a married couple and they both wait till 70 to take their retirement benefits from Social Security, they can absolutely fund maybe they retire at 65. They can do 5 years of withdrawals on a portfolio. And then they might get to 70. Maybe they don't even need to withdraw anything from their portfolio at that time. Maybe Social Security covers everything, or maybe there's a small pension that plays in. But I think people just have to look at these different income sources when they kick in and just be flexible with your portfolio. I think the 4% rule, like, it's a good guideline, but I think it's done just as much damage as it's done good in the financial community, because there are people who are married to that rule. And if you say it's, oh, you can withdraw 5%, you can withdraw 6%, people come at you like, I'm sorry, have you not seen the research? I'm like, yeah, I have, but it's okay. I think just save early, save often. Your future self will thank you. Yeah. Mm-hmm. Yep. Mhm. And I would say to people not to reduce your spendings too much, because I know so many retirees just go in and they're like, okay, I don't want to touch this bucket of money that I've built up. And I mean, you spent your life doing that. Make sure you enjoy your retirement. So thank you for having me.
Root Financial has not provided any compensation for and does not influence the content of any testimonials and endorsements shown. Any testimonials and endorsements shown have been shared with each individual's permission, and are not necessarily representative of the experience of other clients. To our knowledge, no other conflicts of interest exist regarding these testimonials and endorsements. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.